Good day, everyone, and a warm welcome to our webinar where we will unpack the latest findings from Just Retirement Insights 2026. My name is Heather Bell, Business Development Manager at Just SA, and it is my pleasure to be your host today. Thank you for taking the time to join today's session. We appreciate your commitment to helping clients navigate one of the most important stages in their lifetime and financial journey, retirement. Just Retirement Insights is a tracking study powered by Just SA to better understand the South African retirement market and their retirement needs. It tracks how South Africans are planning for and experiencing retirement. Now, in its seventh wave, the study provides a consistent, evidence-based view of retirement behaviours, perceptions, and outcomes across changing economic conditions. So today we will explore the key themes emerging from the 2026 research, the growing confidence gap in retirement planning, how behaviours and sentiment have evolved over time, and what these findings actually mean for retirement income advice and client conversations. The 2026 research highlights important shifts in retirement preferences and behaviours, and these trends are reshaping how retirement financing is understood and, more importantly, what clients need from their financial advisors. So, without any further ado, it is my pleasure, ladies and gentlemen, to introduce today's speaker, Bjorn Ladewig. Bjorn is no stranger to the virtual world. Bjorn is Head of Distribution at Just SA and is a highly experienced specialist in the retirement income space. With extensive industry knowledge and a deep understanding of both the challenges and the opportunities facing retirees, Bjorn brings a practical and insightful perspective to retirement planning. Bjorn is also a qualified actuary. We are delighted to have Bjorn today, and we're delighted to have you today. We hope that you enjoyed today's session. As a reminder, as Matthew mentioned, you're welcome to submit any questions or comments you may have using the question panel throughout the session, and we will address them either at the end or after the session. Over to you, Bjorn.
Awesome. Thank you, Heather. And hi, everyone, and welcome to today's session on Just Retirement Insights. As Heather mentioned, my name is Bjorn, and I'm Head of Distribution and Marketing here at Just. Just Retirement Insights is a tracking study powered by Just to better understand the South African retirement market and their needs. It's one of the first studies in South Africa to focus solely on the retired and the pre-retired, basically age 50 plus. As Heather mentioned, it's in its seventh release. We started in 2015, relaunched in 2018, did a follow-up in 2019, a bit of a special one in 2020 to assess the impact of COVID-19. And then since then, we've done full tracking studies every 2 years. So in 2022, 2024, and now this one in 2026. We set out for an original sample to be at least 350 people. But as you will see on the page, and maybe just to show you there, we ended up getting 446 responses, which is fantastic. We check that we achieved the basic quotas that we want, and because the sample was a bit bigger than what we expected, the quota was slightly different to what we set out, but nonetheless representative. So here we look at the different profiles in terms of race, gender, age, and household income. And as you can see, quite a nice distribution. Same with employment status, education, language, and marital status. All in all, this nice spread meant that we could say this was a representative sample of South Africans aged 50 plus. And of course, that is very interesting to us. We, being retirement income specialists, we love to understand our clients. We're passionate about making sure they have an income for life. And as such, it was good to just again ask them some really good questions. And we're going to talk about that today. And there will be some trends and patterns that we'll look at. The first one is around how changes in financial behavior have been driven by pressures that they experienced. Okay, so on this one, and if for the keen-eyed, you'll see at the bottom of each page, we try to include the actual question we asked, and that's quite important just to give proper context to the question. And as you can see there, this one here is: I plan my finances, I set goals that I want to achieve, and I work towards that. And we've shown the results across the different studies that we've done. And as you can see, generally, planning behavior has improved dramatically since 2018. Yes, there has been a small pullback in 2026, so slightly fewer agreeing or strongly agreeing with that question. But it still shows that planning has become far more mainstream than it was a few years ago. Now, when things got tough, spending confidence dropped fast. Even as conditions stabilized, the old peak didn't return. The mindset shift looks persistent, not temporary. So this shows that people may be spending less by preference and more by necessity. So that implies a higher anxiety and need for certainty. So interesting here, you'll see that on this question, so I do not save much or plan for the future. I prefer to spend money when I have it. There was a definite pullback in that COVID area. More spending thereafter, but then slightly slipping over time, but certainly what we would call a sticky aftershock after this dip here during COVID. So what we're doing today is you'll see on the site and the study that we released that it will cover the other slides, but we've interjected these for today's session with a few thoughts, and this is just our personal views, just a few things that we wanted to highlight for advisors. This applies equally to clients too, or other people who are involved in the value chain. You'll see them with these black bars and the spectacles at the bottom for all you clever folks. But like I said, just some tips. Some may be obvious, some may spark some thoughts, but nonetheless, you'll see that interjected between the various patterns and trends that we highlight, just some things that we set out for advisors. So here, one thing to take away from this is to make goal setting concrete. Most clients come to you with aspirations, but not numbers. And we think it's just very important to start a discussion by anchoring to a monthly rand amount. I know we often talk in percentages and we often think about it in that way, and that's probably the right way. But clients generally out there think in rand amounts, maybe annually, but mostly or mainly monthly rand amounts. Then our research shows that with clear goals, they are more confident. So I help clients to see that a defined income floor makes these goals achievable. So link goals to guaranteed or secured income. Back to our questions and surveys. And with this question, and here the question was, I do not mind taking risks with my money for saving or investment purposes. You may already see a very, very similar kind of shape to what we saw with the saving versus spending behavior. So here, the peak of the risk tolerance was in 2019, so just before COVID, a sharp risk aversion shock in 2020. Then a very strong rebound, but then interestingly, a pullback in 2026. And what we could see here, so caution is definitely more persistent than pre-2019 levels, and it has stayed. But interestingly, there has been a slight pullback in the last survey. One thing to note maybe was when we did the field work for the study, this was done just before the Iran war broke out. So I'm quite sure that if we were to do this now, it would show probably a slightly different picture, something that maybe just to take into account. But nonetheless, it already showed even before that there was a slight pull towards risk aversion. Okay, and here what we asked is what kind of or what level of market crash can survey respondents handle? and you can see here we asked it in different buckets. The green buckets being from 0 to 10% only, so that's a high vulnerability. Then there's some capacity for loss, so they can take, so that orange zone in the middle is 11 to 20%. And then finally, truly resilient to losses is that where they can handle 20% and higher. So in this case, 21% and up. And it's only really that 8%, so that 4, 1, and 3% there that we deem to be truly resilient to market shocks. This number was 6% in 2024, so it's actually a little bit higher than then, maybe simply because we've had generally good market returns up until the end of last year, but just looking recently, returns have now been relatively flat since the end of last year, looking at equities, thinking of the JSE Aussie in particular, but maybe that is also why there's a slightly higher resistance to market shocks, but certainly nothing very high, and we'll be talking a little bit about that today. Okay, so let's recap what we have seen thus far. People may be forced to spend less, but they still hesitate to take risk with what they have. From a savings behavior point of view, the caution has become sticky. From a risk behavior point of view, the confidence has rebounded, but not completely. So it does look like confidence returns faster than caution, but the risk appetite does not fully reset. And the capacity for loss, as we showed just now, is structurally low amongst pensioners. As we showed, even a moderate market fall would threaten their retirement security, reinforcing why certainty and not volatility dominates retirement, or should dominate retirement decision-making. So let's now talk a little bit again about what this could mean for advisors. So the first one we said here is name the gap explicitly. Clients who've saved diligently for retirement may still feel uneasy, and it's good to help them understand why. And the typical risks in retirement are around inflation, longevity, and then investment risk, or simply put, sequence risk. And as you know, that is just a exacerbated or magnified issue when you decumulate, so when you withdraw from your portfolio. Maybe one other thing to note is that one shouldn't mistake activity for security. So saving is necessary, but it's not sufficient, meaning even if you have saved sufficiently or at fairly good levels, you must think through it appropriately how that's then applied in a structured income solution, where that should certainly look at security and growth, not just growth. Okay, so let's connect some patterns, and I'm going to put down some things that I've showed before or similar to what I've shown before, so that we can see some trends. And that's where the survey becomes really interesting. If you start interconnecting things we have seen. And here, starting with that savings line, we've just crunched it, but you may recognize the shape here, dropping down in 2020. Went up again, and has come down a little bit since, but did stay at that level. Then the orange line, where the risk tolerance has fluctuated. So the comfort, so the investment comfort with investment risk dropped sharply, and it only partially recovered. And here, as you can see, the confidence, as a reminder, the confidence recovered faster, but then the behavior. So here is almost maybe the confidence, but the behavior took a bit longer. And then finally, when you ask around what they want, and you'll note the question at the bottom, I prefer a secure, guaranteed monthly income in retirement over an income that might change depending on investment returns, just at the bottom there. You'll see that green line. And this is really to show that over time, it has varied a little bit, but generally the preference for secure, guaranteed retirement income has been consistent throughout. You'll see that line has been pretty consistent, even heightening a little bit in 2020, coming down a bit, but certainly compared to the others, it does look very consistent. And the answer to that question stayed tightly between 77% and 86% over this period. So our next theme revolves around whether survey respondents felt they were ready for retirement or not. So here, and the question was, how confident are you that your money will cover your monthly expenses in retirement if you reach the age of 100, allowing for inflation? And we've only shown two categories here, so the confident and really confident responses. And here you can see over time, so 2019, 2020, 22, 24, and 26, how that has changed over time. So interestingly, confidence or answers to this question was particularly high in 2024, but it has dropped quite significantly, not as low as what we saw in 2020, but similar to what we saw in 2022. And maybe just to, we didn't denote it here, but in 2024, 63, as you can see there, said either they're confident or really confident. And this dropped to 46% in 2024. The low point of 2020 was at 40%, interestingly. So what does this mean for advisors? And here it's around addressing this crisis around trust or confidence. So I think one thing is to acknowledge that drop. So now don't talk around it, talk through it. Retirees' confidence in retirement fell significantly, as you saw. So acknowledging that economic reality builds trust rather than projecting false optimism, which, as we know, would just eventually come back to bite us. Another thing to talk about is to try and reframe the conversation from growth to protection. When there's lower confidence, clients are certainly more receptive to certainty than upside. Luckily, we have had quite a bit of upside in the last few years, but as you also probably know, markets are back to being fairly volatile. So give them that confidence. So lead with what's guaranteed or secured or safe, and then discuss growth as secondary. And then an interesting thing maybe is to think about what frequency of connection or check-in may be required. I'm sure we aware of this, but if things go well, less frequent check-ins may be okay. But when confidence declines, a proactive check-in would definitely go very far. Okay, so this is probably one of the nicest things that we brought out in this year's survey, and it's really around showing and understanding that confidence gap that we've seen. You'll see two axes that we put down there, and the one was around that confidence, where we asked them about their planning confidence, and secondly, how much planning have they done? So the first question, maybe just to go back on the vertical axis, is to rate your level of confidence that your income will cover your monthly expenses in retirement if you reach the age of 100. So basically income confidence stretching to 100, and the horizontal axis, have you calculated retirement needs or have a formal financial retirement plan in place? Now, if we look at the top part, so that's where they have a high confidence, and if you then split it between the level of planning, top left will be where they are what we call casually confident. So they've done, they are confident, but with little planning, and good to see that none fit into that bucket. But then if we go to the bucket where they have high confidence in that income and have done planning, we can safely say they are prepared and calm. And that's a good thing. Turning to the bottom, so bottom left, so where they have done lower planning and they've got low confidence, they are certainly unprepared and exposed. And then the other final quadrant where they are prepared, so they've done the planning, but they have low confidence. And this is quite telling. So bottom left, 33% sitting there, and bottom right, 21% sitting there. So what does this mean for advisors? And let's turn to the three quadrants that we've highlighted, because I think it's safe to say that the ones that are what was the top right and that prepared and calm, they probably of the three quadrants most okay. So let's talk about casually confident. In our survey there weren't any ones there, but it doesn't mean you may not come across those. And there it probably suffices to say that these clients don't think they need you as advisor, but that's only yet, because we firmly believe that especially when it comes to retirement, you must seek financial advice. It's such a big decision to make, and you need all the help you need. So with those, maybe they are not casually confident, but just naively confident. So surface the risk they haven't considered, but without alarming them. Talk about, without being alarmist, realistic longevity and inflation risks. Thinking about the ones that are prepared but worried, this is probably the segment where you can add the most value. They've done some work, but they don't feel safe. There they need structure from someone, structure and guidance from someone. Be the guide there, let them be the hero. And then finally, the unprepared and exposed lot. So here, urgency is a tool. Behaviorally, humanly, we kick for touch. We wait till tomorrow. We don't want to deal with the challenges. And there, I think it's worth it to have a real hardcore discussion around the cost of delay, and that every year of deferral actually has a quantifiable RAND cost. When there are some things that we mention here that you wonder about, we have some tools and information available which could help you to highlight those to your clients. So pulling that together and recapping some of the trends we saw here, the drop in confidence in 2026 suggests people are worried about outliving their money. Rising cost of living is likely driving that pessimism. The high uncertainty rates suggest many people lack that clear visibility, so they don't have that comfort and certainty. And then planning is maybe not so much a problem anymore, but the real shift we're seeing is not that they don't do it or they don't apply the effort, but it's a lack of certainty. And there's a lot that we can provide and that you can provide to help them with that. Okay, so let's move on to the next section and here our question was simply something that we've asked over the years, and that's that we rate, and you'll see there are seven items that we ask survey respondents to rank how important it is for them. So 5 there we asked about extremely important or all the way to not important. And then as we've seen consistently, maybe some shifts between exactly where these blocks sit, but I can say that generally this is what we've seen for many years in a row now, but it's worthwhile unpacking those again. But then on the left-hand side, you'll see what we call these non-negotiables. And these are things that the clients then highlighted as the most important for them. And that's income must last as long as I live. It must cover medical aid and frail care. Income should not be affected by market movements. Income should keep pace with inflation. And then maybe just dividing line between looking at how important they noted it in terms of nice to have, there's legacy for family, flexible drawdowns, and that income that varies with markets. And especially the last one, it's probably safe to say that generally people do not have the stomach for that. So going back to what so here the question is, importance how you would use your retirement savings when you retire. And here's for income for life, long-term care, debt repayments, partner support, financial legacy, and lifestyle spend. And again, what we saw in 2026 is that the priorities have actually pretty remarkably stayed unchanged. But elsewhere, we do see where the pressure points are perhaps more visible. But right at the top, 75% saying that they would use their retirement savings for an income for the rest of their lives. So what does this mean for advisors? And it starts by focusing on that 75%. They already want what you're offering. So in a way, it's not a hard sell. It's matching a stated need with a known solution. And here, talking of what is available out there, it does not necessarily mean a life annuity or guaranteed income, but certainly a secure income. And that could nowadays be either a guaranteed annuity or a living annuity or combination of the two. But nonetheless, that's where you can go in and provide that certainty with a secure and sustainable income solution. Then maybe just to highlight again that we need to also then lead with not just income, but how that would match inflation over time. So inflation protection. Inflation has generally been at lower levels, but it is picking up again, and clients will fear that. And it's good to speak into those fears and offer them solution and comfort where you can. Then it's important to make alternatives of what else is available clear to client. Generally, they underestimate drawdown risk. So here we're talking maybe about going into a pure living annuity, which is a great product, but there it's even more important that you watch those income levels. So basically have sustainable drawdown levels. And there a simple illustration, for example, of how a living annuity can be depleted by a bad sequence of returns, especially if you're drawing down at higher levels, could help just to bring that message home. Okay, so to recap this theme now, as you saw in 2026, survey respondents still felt that lifetime income is non-negotiable. Generating an income for life remains clear and dominantly important to them. It's ranked the highest consistently throughout the year, and that reinforces that longevity risk continues to outweigh all other considerations. Long-term care and medical needs stays, and the need to cover that remain very high. And as you know, that is a growing concern. Medical inflation and care inflation generally is higher than normal inflation, and that is something that one needs to unpack with clients and give them comfort around that in terms of the solution that you land on with your clients. And what we've seen is that with the rising pressure, retirement savings are increasingly used to manage risk and debt so not just lifestyle. So it's almost necessity things rather than spending it on good times. And yeah, it's a reality out there, and it's worthwhile being cognizant of that and managing around that. And I guess that's where, from our point of view, we help as much as we can at retirement, but it does underline that the savings culture remains just a very important thing to consider. Okay, so then on to the next section where we talk about the fragmented backup plans we see. Then we're going to talk about unplanned cognitive decline, and then finally what we call the longevity funding gap that most retirees are not accounting for. So let's talk about this. Here, the question was around who they would turn to if their money runs out. And as you can see, so 2026 being furthest to the right, so almost like a chronological thing. At the bottom in coral, the just pink, you'll see that the reliance remains highest on children and grandchildren. Very similar to the last survey, but lower than what we saw in 2020. 2020 was fairly unique. Actually, you'll see 2022 as well. But then the last two, so this last survey and the one before being very similar. Lower reliance or indicated reliance on government, but still relatively high, being the second highest one. Then friends and community, and then finally other family. Interesting that that's the highest of the surveys we've done. Not sure how much one can read into that, but nonetheless, that's interesting. And maybe the drop, or what we read into the drop on the reliance on state report and maybe state support, and maybe that's just that they're sensitive to the broader environment and not necessarily considering that government will be that port of call, but rather first relying on children. Okay, so here quite a two things that we combined again, which is quite interesting. And firstly, on the left-hand side, asking clients about their view of what their health is. And as you can see, with the answers being average health, above average health, and very good health being quite high, so almost like a quarter in each of those, and then even higher than a third saying that average. So in total, generally respondents saying that they believe that their health is above average. But then interestingly, and that's on the right-hand side, when asked whether they've thought extensively about planning for Alzheimer's or dementia, so in other words, cognitive decline conditions, only 2 in 10 have thought this through. And that's actually down from 3 in 10, so a lower percentage thinking that through. And it's maybe worthwhile just pausing here, because that is a general trend we're seeing just from a statistical point of view. We hear a lot about extended life expectancy, so people living longer than expected over time, but then not always necessarily living healthily for longer, but rather the bit at the end, the unhealthy life expectancy, extending more and more. And that then speaks to things like dementia and Alzheimer's, where they are still alive and for longer, but unfortunately not in a healthy state. And I think here it is just very important to think through that with clients. And it's rather alarming to see that fewer have thought about that. Maybe because it's so far in the future, and I get that. But we do, if you want a good and solid financial plan for the rest of your life, that is certainly something you would want to consider. Okay, now let's talk about the longevity gap problem. And this is maybe where the rubber hits the road, and the reality and the maybe the disconnect in reality between what is possible and what is reasonable can really be seen. So I'll just park on this for a moment. And there are a few questions in here, but it's really driven by two questions that we asked. And that is around how much savings respondents have from which to look after their retirement or income, well, retirement and income needs, and then asking them also what kind of income would they expect or would they need. And as you can see here, so on average, or the median savings level is 1.6 million, so that's there. Yet when we asked about the expected monthly income level, it's more around 10,000 rand. So let's call it 10,000 rands per month. Now, if we turn that into what can be expected, and you may notice here some calculations, but let me walk you through that. When we look at a living annuity, a solution as an example, or let's call it any general drawdown product, the general rule of thumb is when you retire, so let's call it at younger ages, you can safely draw down at 4%. Some may say it's higher, so let's call it 4 to 5%. But for the purposes of this, just because the gap is large anyway, let's assume it's 4%. And that then means if you turn it over, and that's why we're saying, so 10,000 per month would be 120,000 roughly per year. And that should give you, from that, if you can safely draw down 4%, it means you need 25 times that amount to be able to safely draw that. And that's the times 12 and times 25, which then gets you to 3.07 million. Some of you may have heard of the rule of 300, and that's really, by the way, just that 12 times 25 is 300. So another rule of thumb, and I mentioned earlier as well that people tend to think in monthly rand amounts. You can see it here that 10,000 rands per month, for that you roughly need 3 million rands. And extending that, maybe just to make it real, or give you a bit of that range and spectrum. If you wanted 5 times as much, so that's 50,000 per month, you would need 15 million rand in a pure living annuity. And back to what we've seen, so expecting 10,000 but only having on average 1.6 million means there's a 48% funding shortfall that we see across the people that we've surveyed. And what does this mean? So legacy is often a want but not a true need. And why we say that is it's indicated that 41% want to leave something behind, but so many more say that an income for life is important. So first make sure that is secure, then look at what's left to pass on, because that is what we do often see, is that people want to leave money for their kids, but unless they have a sustainable income plan, they may ironically become dependent on exactly those people who they wanted to leave money to. Then something we picked up, and that it's worth talking about, and that's that joint life planning is likely underserved out there. It's important to say that. When we asked about life expectancy, you could see that generally respondents expected their partners to live longer. So survivor income is critical, and it's important that you help and guide them through that. And then finally, that estate conversation actually opens the income conversation. Maybe similar to the first point, and that's that don't focus only on legacy, but first make sure that the longevity risk is appropriately managed. And then from that, you could have confidence in the estate planning discussion. So talking about a few gaps that we've seen, so that we've mentioned this funding gap, but pulling a few others together, what we see that is that people expect to live to 85. That was the average answer that we saw, but only 54% have, well, sorry, 54% lack the confidence that their money will last. So very high level. Similarly, only 34% haven't calculated retirement needs, so also falling short there. And also on the care support, just how important that is. And then finally, as we've mentioned before, 83% when asked, saying they prefer a guaranteed income protection. So what is this quiet transfer of retirement risk that we've seen? And that's, as we showed, that family remains the primary fallback, but that is increasingly under strain. I think less and less can people actually reasonably or rationally rely on children to look after their financial needs. Government and community support are filling gaps, but also not necessarily the same level of confidence in that. And then we spoke about legacy goals and what is actually required from a financial income point of view, and making sure that that should be served first. And then even though people are saying that they are generally in good health, they have not thought through some of the cognitive decline issues, and it's very important that we take that into account. Okay, so then looking at what this means for advisors. So clients' worries are not the same as the risk that will hurt them actually, and this is about a behavioral thing that we often see, and it comes out in the survey as well. So for example, market volatility will often get a lot of attention, but then things like longevity and inflation are the real killers, for lack of a better word, but they're not necessarily discussed and broached. Then family being a fallback plan is a fragile plan. I think here, even though it's difficult to say, retirees should be more selfish in the sense that they should first make sure that their income needs are taken care of, and then consider either legacy or who they would fall back on. So getting that focus back to income certainty. And then frail care, so the cognitive decline risk, that's an unspoken risk, and only 20% having made real plans around that is a concerning figure. So then, again, pulling into some of the things we've seen and putting numbers up here. So as we mentioned before, so planning behavior has improved. So 37% have a formal written plan. 85% have some form of plan, yet 54% are not confident that their money will last to age 100. So that means that they still have generally low confidence in their plans, and this is where we could really come in to assist them with that. Then an interesting thing that we saw around retirement age. So we asked them as well what would be their ideal retirement age. And you'll see there's some numbers here as to the kind of answers they gave. 90% said between 60 and 64, 16 between those ages, and 9 between those ages. Yet when we asked them what the probable retirement age is, you could see that shifted to a bit later. And that could be an interesting thing to track over time. Certainly when we engage in the market, we hear more and more people either rather flexing into retirement, so doing partial financial retirement only, continuing to earn money, maybe not on a full-time basis, but continuing with that, or literally just delaying retirement as much as they can. That's not always that easy, and of course, life happens and people's conditions vary, and that has to be taken into account. And that's back to one thing we may say, and that's even though there is that does help when you extend the working career. It's something to consider carefully, but there is hope in that too, because that generally drives two things. Firstly, by retiring later, you save more, but then secondly, the practical thing is, as your life expectancy or your remaining life expectancy then reduces, it almost has a double geared effect by doing that. Then about talking about needs and finding sort of and matching needs with solutions. We asked, and 58% said that they found it easy to find financial products that fit their needs. 15% couldn't say. they found it neither easy nor challenging. But then 26% found it challenging or very challenging to navigate. And that's back to why we were saying that we believe, especially for this age group, financial advice and formal financial advice is so important. So a well-positioned advisor or accessible, easy solution, or in fact both, would help to close this gap. So the overall message and needs have actually remained quite clear, and that's around making sure they can secure a sustainable income. So what are the non-negotiables we learned about in the study? And we'll talk quickly through them. And the first one is that certainty is non-negotiable. Across all measures, retirees consistently prioritize income security over flexibility. So that's talking about certainty, and that they do really put a lot of value on that. Then lifetime income matters most. As you saw, that remains the top priority. Next one, that protection beats optionality. People will talk about flexibility and optionality. And even though that doesn't mean that's not important, there are other things that are more important to them, like covering medical aid and frail care, keeping pace with inflation, maybe often undervalued, and then being shielded from market volatility. Flexibility and legacy are secondary. We spoke about that. Then behavior has been pretty consistent over time. So even as the confidence, risk appetite, and spending behavior fluctuated, the income priorities remained. Self-preservation dominates decision-making, something that I spoke about being selfish, and it's good to see that. I do still often see that that's not put in the first place. I would love to see that. And then what we mentioned about partners and making sure that a proper joint plan is in place, and not only thinking about the main or the one partner, but making sure that if it's a couple, that both have a good plan in place. Finally, spoke about it a few times, and this is just what we would put out there. We do remind people who read this that they must truly consider getting a qualified financial advisor, and they can contact us, and we'll recommend, or we'll give them a list to choose from. Okay, so with that, I'm just going to see, I noted there are quite a few questions, so let's see how we can deal with those.
Thank you, Bjorn, for sharing your expertise and insights from Just Retirement Insights. We trust that today's session provided valuable perspectives and practical takeaways to support your retirement income planning conversations. We'd now like to take some time to answer the questions that were submitted, and thank you for submitting those questions, right? Some of the questions were already answered during the session. However, Bjorn, the following questions would benefit from your input. First, we have, while your sample shows a preference for guaranteed income solutions, in brackets 77% to 86%, do you know what South African retirees are actually implementing across the market?
Okay, great. I see Paul Leonard asked that. Hi, Paul. Thanks for the good question. Yes, and that remains telling. I didn't. We wanted to focus on the survey here, and as you stated, that is what the respondents, so the 446 people we asked, stated. Yet, in reality, what we see, and there have been shifts, but it has reverted back. So let me just spell out what I'm trying to say here. So one way where we gauge that is if you consider the at-retirement money flows and whether that has gone into living or life annuities. Yes, we know there are blending options too, so maybe and the numbers are becoming a bit fuzzier as a result. But from what we can see, and why I say that's flows maybe into living annuities, but they're blending there at least. But certainly from what we could see, around 2024, so maybe let's go back further. We used to see a 90-10 split in monies, so 90% going into living annuities and 10% into life or guaranteed life annuities. As markets struggled a bit, uncertainty was a concern, certainly following 2020. And as you know, yields were high, so life annuity rates, nominal life annuity rates, just looked very juicy. That probably shifted to 60-40 from what we saw. And the latest we saw is probably back to 80-20, maybe even 85-15 now. So it does look like there's a better, and why I say better behavior, it's not from a pure product point of view, it's just from considering the kind of responses that we see here and knowing what people draw down and what a safe drawdown would be, and seeing how many are actually beyond that, you would expect people to blend or annuitize more, but behaviorally that remains a challenge. So yeah, so what we're seeing is probably 80-20 at the moment. Time will tell, and some of that is driven by yields just coming down from its peak. Not that they're bad, they're actually still very good. Markets having done extremely well, but you heard me also say until the end of last year, and that's been flat now. So it will be interesting to see how the rest of the year goes in terms of that. And then mentioned blending a few times, so the combination of the two certainly becoming more mainstream. That's what we're seeing, and I think that will shift behavior too.
Thank you, Bjorn. The next question is there benefit in pushing protection in a current growth environment?
Good question. And I think there's certainly a place for both. And let's talk about that quickly. So when we say that the combination of a living and a life annuity, for example, gives you good opportunity to have both. So continue to grow your assets, but then make sure you have secure income. So what's interesting there is that even if you value growth, by drawing down too high, you do expose yourself to sequence of returns risk. And another way to think about it is, why not convert some of the growth that you've seen? So we call it bank the rally. Why don't you convert some of the growth that you've seen into a sustainable income? Life annuity rates have come down, but they've actually come down, generally speaking, by less than what the markets or balance funds have grown. So good time to convert some of that and give yourself then protection. So it does two things. It literally reduces the drawdown rate on the rest if you secure a part into a life annuity income, which gives you higher income than what you can draw down safely. And it also, which is really linked, but it certainly gives you more sequence of returns risk protection. Okay.
Thank you, Bjorn. The next question is, which escalation patterns are proving to offer the best inflation protection?
Okay, good question. And the way I would answer this would be around also what the client may need. So when we talk about guaranteed, so life annuity income, there are generally two types of increases. The one is what we would call fixed escalating. You could also put inflation linked in there. So that's known increases. It gives certainty, but we do say a bit of false certainty, simply because you may pick a 5 or a 6% escalation income, which sounds like a good income escalation, and it currently looks good. But because you're looking at such long run times, you're just not sure what inflation is going to do in the very long term. Okay, so in terms of simplicity, yes, but then there are also styles of products where increases are linked to the returns of an underlying balance fund. And as we all know from good investment, diversification, and other principles, if anything, by investing into a combination of bonds and a balanced fund should just give you better returns in the long term, and those increases are expected to keep pace with inflation much better. I mentioned inflation linked. Those are good products too, but unfortunately they're generally quite expensive in South Africa, just because there are fewer index-linked bonds available that these products have to invest in, and that drives up the price of those, or differently put, it reduces the starting income that you would typically see on those products. But yeah, that would be our view on that.
Thanks, Bjorn. Next question is in two parts. You say 45% need care. What is the average age at which you see the increase in income needed to support healthcare and other care take place? Then, to add to that question, what are the phases of retirement in terms of income needs, and when do you generally see a jump in needs forcing higher drawdowns?
Okay. It's really good questions. I'm going to start by saying, in terms of care, we don't know that precisely. We do ask respondents about that, and I think the low amount that said they planned about it probably is a bit of a concern. I would generally say that's higher ages, so we're talking above age 80, but as you can imagine, that varies quite a bit. Interestingly, our parent company in the UK offers a life annuity specifically for care needs, but there generally we're talking about very old lives, age 90 plus, and then maybe I should add that females typically as well, but just because they live longer than males. So don't have a precise answer there. I'm sure there are good studies on that. On the phases of retirement, what I'd like to mention there is, you may have heard this, we experience that when we engage with advisors and clients, but there's often a U-shape in spending pattern. So at the beginning of retirement, they spend more, then there's a period where they tend to save and a little bit more at home, enjoy their coffee on the stoop, and then it picks up again, and that's because of the care and health matters often just coming into play, and that's what we do often see. We don't have that exact shape, but we do see that retirement outgo smile or U-shape, as what we often see.
Thank you, Bjorn. The next question is, when a client has a large shortfall, where do guaranteed solutions fit in? As an example, if a client has 1.5 million rand shortfall, how does a guaranteed solution help when the gap is this big?
Okay, good question. And this comes down to, you may recall that I applied that rule of that 4% rule, and that's based on our view. Maybe I could actually see if although we are running out of time, right? So it's this page where we spoke about that a rule of 300 I also mentioned, and that's that 4% rule. So where guaranteed income or life annuities do help is that the effective level of income you can get from those products are much higher. So rather than the 4%, you, for example, talk about a 6 or a 7%. I'm waiting for the ones with kids to smile now when I say 6, 7. And that literally just means that your funding shortfall, so that 48% there, would drop. but it does not necessarily solve everything. It's not necessarily the miracle, but it does make the savings that you've diligently saved stretch much longer. So simply put, I'm going to do some head math now. You probably to get for that 10%, that 10,000 per month, you probably need 2 million rand as an example. And yes, on average, there's still a gap with a 1.6 million, but it certainly gets you closer. And that is why your guidance from an advice point of view is so important, to think through those options with a client. We talk about different zones depending on what drawdown level you're aiming at. There's a safe zone where if you're drawing down safely, go into a pure living annuity. There's an annuity rate where above that there's a danger zone, so almost like this case, this average case where they are at, where you'd need to look at either saving more or reducing your income needs actually. And then there's a zone in between, which we call the risky zone. So between the drawdown rate is between the life annuity rate and the safe drawdown rate. Then you must certainly consider blending, which means you can take that rate, you don't need to reduce it, but you combine the two products, and with that you have a more sustainable combined solution.
Thank you, Bjorn. We have come to the end of the session. There are still some more questions, so I'll just mention that a recording of today's webinar will be made available, right, and attendees will receive the CPD points for participation, and we thank you for joining today. For those who would still like to continue staying on, there are some nice questions, Bjorn, that I think will benefit from your attention. So if you don't mind to stay on, you could, but those that are that need to leave, you are welcome to do so. Thank you so much for your time today. Bjorn, as I mentioned, there are still some questions, and I'm just going to share that with you now. The next question is, please elaborate on mortality credits. Buy a life annuity now while still earning an income, so increasing my taxable income, or wait and buy one later.
Okay, and thanks, Etienne, for asking that. We spoke just the other day. Yes, so the concept around mortality credits and what that is, and let me just talk about that. So in a life annuity, you invest into a pool where those, firstly, the life insurer who manages that pool can do calculations based on the average life expectancy. And that, by the way, is why life annuity rates are higher than safe drawdown rates. And how that works is within that pool, those who live longer than expected are subsidized by those who die sooner than expected. But on average, this thing works. And the benefit you get from that pool, so by using this insurance concept, we call survival or mortality credits. So it's literally, without being harsh about it, it's literally those who die who leave the pool and leave a bit of money, the rest benefit from that. So it's the reverse of a life insurance, where the unlucky one who died gets the dependents get the life cover, even though she only paid a smallish insurance premium into the pool. Now, if you extend that, it does mean the earlier you buy an annuity, the better. The reason for that is that pool concept, when you wait, let's say 5 or 10 years, on average, that whole pool would be expected to live longer than what they were expected to live 10 years ago. So let's give you an example. Age 65, average life expectancy of a male is to age 82. If you wait 10 years to age 75, then that life expectancy isn't 82 anymore, it's now 86. So that 4 years that was added has to be taken into account in calculations. So by not annuitizing, you lose out on 10 years of mortality credits. It does feel counterintuitive because, yes, the annuity rate will be higher 10 years later, but there's enough math and things to show that you've lost out on that opportunity. And that's back, in my view, to saying, okay, but what level of income do you need? if you can afford to draw down safely, so I mentioned this safe zone, then that's okay. That's your solution. But if you do need something that gives you higher income levels, you have to consider either blending or fully annuitizing. And in that case, the answer to the question when is now, and it's because of that mortality credits I explained. Okay.
Thank you, Bjorn. The last question. What are your thoughts on the lowest South African CPI inflation target of 3%? Is this realistic long term? Will fixed escalation rates of 5% become a thing of the past?
Okay. So I want to ask my lawyer here because I'm not going to venture long-term views. But what I can say is that, yes, we have seen lower inflation rates, but it's creeping up again. 3% being attainable, there's so many macroeconomic factors that play into that over the long term. It's difficult to gauge that. And maybe that's back to what we were talking about, what escalation options there are. So let's say inflation stays at 3%, then 5% is a great escalation rate. But let's say inflation goes to 10%, then of course that's not sufficient. And it's so difficult to gauge that. And it is a conundrum in that clients want certainty. They believe a 5 or 6% increase gives them certainty, but it actually doesn't, because inflation is unknown. And here we are, it's impossible to predict inflation a year ahead, let alone 30 years ahead, which is why if we go back to core thinking, we would advocate rather going for an inflation-linked income, although I mentioned it's quite expensive, or having increases where you have more confidence that even in the long term, it would better match inflationary increases. And that's the product that I mentioned, where the increases are linked to the returns of an underlying fund. It's generally called with profit annuities in South Africa. We just call it our just lifetime income. And back to talking solutions, that is why that exists in South Africa, because that is a way of having a lot more confidence about getting inflationary increases in the long term at a better price than that an inflation-linked annuity can offer.
Thank you, Bjorn. This is the final question that we'll be taking. Is it important to distinguish between CPI and pensioner inflation?
Absolutely. And even this discussion about, and that was just CPI, the reality is, and I mentioned medical aid and medical costs and care costs, and those do typically have, and often I would say inflation plus 3 or maybe an inflation plus 5%. And that's an even more difficult discussion to have with your client. I guess the benefit there is we don't, that's not all our expenses. That's a part of it. Although back to that question around the shape or the phases of retirement, we do see a period where those kind of expenses will have a relatively much higher proportion. And that's likely the way I would tackle it practically, to say, well, let's have a plan in place which gives you inflationary increases, but hope that or expect that there's a period where maybe you don't need to withdraw as much and you can build up a bit of a savings pocket, if I can put it that way. So remember that U shape that I mentioned. So maybe have an income that's rather solid throughout, but just build up that pocket during times where you don't need as much income. And why I put it that way is unfortunately there aren't products out there that will give you medical inflationary increases. I think, well, firstly, it will probably just be too expensive. So even though technically you could have it, no one would buy it. But absolutely, very important to distinguish between those, have those discussions with your clients and plan accordingly. And like I mentioned, but start by at least making sure that inflationary increases or that inflation risk is mitigated. If there are elements that are higher than that, you can pick higher escalation options, or at least have a plan whereby you put money aside, so build up a bit of a pocket to cover for any expenses that are higher than inflation.
Thank you so much, Bjorn. That's a wrap from the Q&A session we have time for. Thank you again for joining us for today's session. We appreciate the important role that you play in helping clients achieve a better later life. As I mentioned, the recording of today's session will be made available along with the CPD points that will be awarded, as well as the recording and the certificates that will be issued. As always, Bjorn and the Just team is obviously always here to assist with any questions that you have. And we again thank you so much for your time. Have a wonderful day, and thank you again. Goodbye, just for now.
Thank you. Bye-bye.